3, 2, 1, and 0, and liftoff.
Hey everyone, this is Greg Lafferty, the Rocket Guy, and you're listening to the Rocket Guy Real Estate Investment Network, where we talk about investing in real estate because that's just what we do. Come check us out at therocketguy.com, where you'll see tons of extra resources and materials and other things like that. Come check us out. There's some live presentations and other things that will help you on your education so that you can decide if real estate investing is really right for you. So today, we're going to dig into a few little tidbits, a few little secrets about how to build good, strong relationships with your lenders. Lenders are important team members in investing in real estate. So if you don't have any access to money, it's going to be a little tricky, okay, buying real estate. This is not like $50 worth of stock, okay? So let's ask that question. Why do we need lenders? Right? I'm just going to go out and buy a house. Okay, good. I'm going to buy an apartment building. Great. Perfect. Sounds like a great idea. Where are you going to get the money? Okay. So I'm going to be a real estate investor. Did you print that on your business card? And that by buying the business card from Vistaprint, that spent all your money? So you're going to need some lenders somewhere out there. Now listen, remember we've talked about debt. Okay. And debt can be very helpful and debt can be very damaging. Okay. So I'm not anti-debt. What I am is I'm into smart debt, okay, if there's even a term for that. I don't know that that's a real term or not, but let's use it, okay, because debt can be very powerful. It can be a tool, just like any other tool. It can be a good tool to help you grow your portfolio, but dang, I've gotten about sandwiched by too much debt in the past, about lost it, okay, so it's something you want to approach very cautiously, right, but real estate is expensive. And we're probably not going to make our investments with 100% cash, okay? You're just not going to go up to typical person's, not going to go up and just whip out $250,000 in cash and go buy a little duplex or something. We're just not going to do that typically. We need some help and we need some partners and we need some lenders. So when we leverage or put loans against our properties, our returns tend to be a little bit higher, right? So we can make money off the bank's money. Okay, which is kind of a funny trickle-down effect, right? We're making money off the bank's money, the bank's money making money off of the depositor's money, or maybe the Fed's lending money to them. So somewhere in there, somebody gets screwed in there somewhere. But if everybody's making a little bit of money, we kind of make it happen. But then as we do that, as we apply leverage, as we apply loans to our properties, we always need to constantly balance out the need for return and the need for debt with cash flow, the need for cash flow, because as we incur debt, then we have to pay it back. And so we have to take a hit on our cash flow to do that. So there's always a balance. I was talking with two younger gentlemen the other week, and we were talking about this. So how do you structure very growth return oriented real estate versus cash return oriented, right? And so how do you kind of balance that out? And it really depends on how much debt or leverage you put on the property is that big lever that you're trying to pull to kind of drive, okay, how much growth, like a growth fund versus an income fund, okay, and trying to balance that out. But, access to money or capital is important to be ready for future opportunities. So we don't have to have the loan, but we need to have good relationships with people to be able to get a loan. If an opportunity presents itself, we have to have access to that capital. And you don't have to have capital through lenders. You could have equity partners as well. So, but that brings on its own challenges of disclosure and how to report that, how to raise the money, and the security exchange type requirements and other things involved in all that. So not impossible, good thing to kind of have and get some knowledge. Maybe we'll do a little episode on that someday. But today, we're going to talk about dealing with lenders. So let's talk about different types of lenders. Most everybody thinks about borrowing from a bank. Okay, I'm going to go to the bank, get some money. And when you go when you're starting in real estate investing, the only thing you have to lean on is either what you did when you bought your first home, or maybe if you've never bought your first home, maybe you're thinking about what happened when you maybe bought your first car. Okay. and that was your kind of lending experience. So most people think about traditional bankers. I love dealing with smaller banks. I love dealing with community banks, banks that want to invest in their local area. That's kind of who I like to deal with. They're just a little easier. They have pretty defined requirements, and you know their process. You don't get lost in a bunch of bureaucracy, okay? But that's just me. Other people deal with the big banks, and it's just fine, but that's kind of what we think about. But other organizations lend money as well. There's institutional lenders, insurance companies, and other things. When you get into big money, they usually have pretty high minimums. They don't want to invest anything less than $1 million, okay? So, or lend money less than $1 million or so. So you're kind of getting to that level. What about hard money? Okay, you can go out there and find people that are just lending money on real estate, but they're not banks. It's a very private kind of individual. Maybe they set up a company and fund it, and those people are charging higher interest rates. But they have generally easier lending requirements, right? They're taking more risk, so they're expecting a higher return. And so we call them the hard money lenders, okay, because that money's hard. You know, she's up there at 15, 20%, whatever it is sometimes. So whereas the bank might lend at 3%, okay, you have to make those kind of decisions. And then there's private money. You know, that could be kind of that friends and family, or it could be somebody different, right? And you know, a lot of times people get a little nervous about talking. Oh, I don't borrow from friends and family. Okay, well that's fine, but also you're not giving them an opportunity to invest their money and grow their money either. So so all those can be types of lenders. So let me talk to you about lenders. Let me talk to you about how they think. Very, very simple. Okay. Lenders think very, very simply, especially in banks. Banks are very conservative. And I treat my banks like a partner. Okay. They're not an adversary. These are the guys that I'm out here, big picture, visionary kind of guy. These are the folks that look at me and go, Greg, that is not a good deal. I'm like, whoa. And I learned really early. One of my early lessons was to ask why. Why is this not a good deal? Because eventually, if you knock on enough doors, you're going to get a yes. But maybe that yes is not the best thing for you. Okay, maybe you should have stopped at door number 1 when they said no, and this is a bad deal, and you would have said why, and they would have told you. Okay, so, and that could have saved you a whole lot of heartbreak and heartburn. I had one lender one time that that gave me some money to renovate an apartment building, and I was so excited. I got a loan. I finally got a loan to renovate this apartment building, buy it and renovate it, and I was so happy. And then I realized he didn't lend me enough money. So I was like, dang it, he lent me money. I was so excited. And then I got to the end of the money and I still had project left. And oh my goodness, what a lesson. Okay. He lent what was in his comfort zone. So instead of saying no, he said, yes, but here's how much I'll lend you. And I thought, oh, okay, good. Well, I'll just try to make it work. And then I got it figured out that it couldn't work. It'd have been much better if he'd have told me no. So now the conversation I have with lenders today is, hey, look, if you have a problem with this deal, I want to know about it. You need to tell me, because I might have a blind side, okay, and I need you to protect my blind side. And my bankers are very good at that. They'll sit there and go, no, you know, we don't like that area. The economy's a little thing. And if you know what, if I could still work through that in my mind with a very rational mind and go, hey, look, that's fine. I get it. But here's the things I'm going to do to mitigate that risk, and it's still not within their tolerance, then I go off and try to find another lender. But if they're bringing up a real issue, I need to pay attention to that. So here's the thing to know about lenders, is that the number one rule of a lender is don't lose money. Some people think that a lender's number one rule is make me money. Nope. No, that's not the case. Their number one rule is don't lose the money. Okay. So number 2 rule is make some money in the process. Okay, so number 1 is don't lose it. Number 2 is make some in the process. Number 3 is when in doubt, look at number 1 and don't lose money. Okay, so when we're dealing with lenders, we need to keep that in mind, that what we have to present to them has to be thought out and professionally done, and all to give them a comfort level so that they can follow rule number 1. They have a pot of money over here, or access to a pot of money, and they need to figure out how to invest it so they don't lose it. Okay? Their typical lenders are not out there gunslinging, throwing money around and seeing what sticks. Okay, that's kind of Wall Street. That's hedge funds, right? They're kind of throwing money out there and see what sticks, what can give them a return. Lenders and bankers, they're kind of like, I want something a little bit more predictable. I'm not very risky. I'm very conservative in my lending approach. And so rule number one, don't lose money. Okay. If you can understand that, then that'll help solve a whole lot of communication problems. And as you're building some of these relationships. So let's talk about some of these things. These are very simple. I'm not going to give you some magic secret sauce here. Okay. You have to come up with the ability to deal with people. Okay. Like my friend in Alabama, she says, I don't like to people. Okay. She uses it as a verb. All right. So, but you have to kind of develop your ability to people. But in the end, you need to kind of also, there's a few things to kind of clean up the rough edges, okay, to help as you talk and communicate with lenders. So one thing that I find very, very important in this tip list that I'm giving you is to find out what the lender is into. Every lender has a different focus. Everyone has things that that the banks or whatever they like to lend to or not, or to stay away from. Okay, so they have kind of this list of what's good and what they avoid and what they stay away from. So coming out of the Great Recession, okay, a lot of lenders were like, no, we do not lend on construction of new subdivisions. They might help you build a house, but they were not going to help you put any roads and utilities and other things into the dirt, okay, because they got stuck with a bunch of subdivisions that never came out of the ground. Okay, a bunch of raw land, a bunch of half-built land, okay, and so they were like, nope, not going to do it. We're not doing that. So in a new, when I'm approaching a new lender, and even as I do kind of these annual meetings with my lenders, just to kind of touch base with them, see how they're doing. This is a question I ask them. Hey, what are your targets for next year? What kind of projects are you looking for? Because I'm thinking about the things that I like to do, and I'm trying to find a good match, right? Because there's no need to force a bad match. If they know that they could go up to their approval committee or whatever their process is to get your loan approved, if they know that, look, man, we do not do storage units, okay, and all you do is storage units, that's just not a good match, and it's okay. Their attitudes might change over time, so you want to continue to people to keep those relationships going. Say hey to them when you see them on the street, that kind of thing. But in general, you're not going to be able to get your loan approved if that's just not what they do. Okay, but they always have a target asset class. Okay, we're really into multifamily right now. We have a ton of money sitting out there for multifamily. We're trying to place money in multifamily products, and you go, well, great, because that's what I do. And so there's a match made in heaven there, right? The other thing that you want to do, tip number 2, is, hey man, do your homework. Like, don't show up to a meeting half cooked. Okay, nobody likes to eat a half cooked pie. Okay, we just don't. Okay, and lenders can kind of smell it out. Like, man, this guy's just not done his homework. Okay, be able to answer the question to them, how are they not going to lose their money? Okay, because that's what's in their mind. They're looking at this deal going, how risky is this deal? And if there are risks on the table, acknowledge them. Go, hey, look, you know what? We have a risk here, and here is why or how that I'm going to absorb or mitigate or lessen this risk. Okay, just go ahead and answer the question. Throw it out there. At least that way they know you've thought about it, right? And then ask them at the end of your conversation, like, hey, what am I missing? What am I missing? Okay, or how does this kind of project fit with what you're trying to do? Okay, because all the bankers, they all have a number that they need to lend to, right? They all have targets. They're kind of sales guys. They're selling money, right? So they all have a target. And so they're going to try to fill their target with the easy deals, because if they spend weeks or months chasing a deal they know is going to be difficult when they're trying to get it approved, right, then that's just wasting time. They would rather go and chase the things that could be easily approved. So go ahead and do that. But answer the question in their own mind about how they're not going to lose money, okay? How about our paperwork? Tip number 3, right? How about paperwork? Do we come in there all like paperwork just falling all out of our briefcase and all that kind of stuff, you know? Or do we have it kind of organized? Everything's kind of laid out. It's professionally done. We have project plans. We have budgets. We have all kinds of any kind of calculations, that kind of thing. Make it look professional. Okay. A lot of people learn in different ways. I found that a picture, there's a lot of people out there that are visually oriented, and to be able to talk, so people who are auditory learners, to be able to talk, but then also have a picture of what you're trying to do, really helps communicate. So if this is the first time that you're meeting with a lender and you're trying to pitch a new apartment community, well, heck, man, maybe have some pictures of it. Okay. Or some sketches about similar buildings that you'd like your building to look like, and maybe a survey to say, here's where it is, and a map where it's located, and that kind of stuff. So lay it out in picture form and then talk about it, right? So they can visualize what you're trying to do. They get your vision of where you're headed. This kind of just puts the icing on the cake, right? Says, hey, look, this person's professional. They've done the math, they've done the research, they've looked at competitors, they've analyzed the market, and I see it. I can see what they're trying to do. And of course, you can get experienced help if needed, right? Your bookkeeper, CPA, accountant can help you with the numbers and your financial reports and all that kind of stuff. So engineers and all can lay out, and surveyors and all that can help you with that. You're just trying to get what's needed to communicate to this lender, okay? And try to use all the senses. I even find that it's helpful sometimes to meet a lender at a site and say, look at this beautiful place. Here's where we are. Here's the traffic count passing by here. And here's, by the way, what I want to build here, right? So I don't do that if it's not their target asset class or they're not lending any money at all, right? So, I don't do that, but there's certain phases of the game, it's a great time to bring them out to the site and talk and show and that kind of stuff. So it's all about looking professional, because if you look professional, and you are professional, this is what you do, this is your business, right? It helps answer that question, am I going to get my money back? Okay. Because this person is all about it. This is what they do. They have a track record, whatever the case is, and I'm going to get paid back, right? The other part is do what you say you're going to do, right? If you say, hey, look, I'm going to have a full financial package over to you on Monday, do not let it come on Wednesday. Better if it comes on Saturday. Okay, come early as opposed to coming late. But do what you say you're going to do, because if he's going to lend you, if he or she, this lender is going to lend you money, going to lend you hundreds of thousands of dollars or millions of dollars, then you saying, yes, I'm going to pay you on the first every month. Well, if you didn't show up on time to your meetings, if you didn't deliver the financial documents they requested by the time you told them they would, how likely is it that you're going to actually show up in time to make that payment? Okay. Here again, it gets back to that mindset, right? So the other thing that really helps you with relationships is pay the loan back. Okay. Big tip, pay it back. Not only do what you say you're going to do, but pay it back, because as you move through your real estate investing career, I can guarantee it that if you build a good, strong relationship, those lenders are going to come back for more. Okay. And they're going to see that, hey, look, I lent Greg $100,000 3 or 4 years ago. He's paid it down. He's paid it off, whatever the case is. And now he's up for $500,000. And you know what? He's a good customer. He's good for the money. So I'm going to lend it to him. And so, but if you don't pay it back, guess what? You're going to go to the banker and say, I know I kind of defaulted, didn't quite pay on time. I had some late pays, whatever. I need some more money. And they're going to be like T-Rex and go, ooh, my arms are short. Okay. I'm not going to lend you any money. Okay. And so if you do what you say you do and you're going to pay it back, right? Big tip, pro skill. Okay. As my boys would say, that's pro skill, Dad. So the mindset here is that these are long-term relationships. Okay. If you're in this game and you're just kind of turning and burning and you're blowing up bridges as you go, you're going to live a short term here in this game. Okay. You really are. So you might be able to fool a lender once, but you're not going to fool him twice. So if all you're doing is trying to gather up money and leave a scorched earth behind you, right, of burned out relationships because you didn't pay people back, that's not going to go well for you. But if you approach this as a long-term relationship, a very long horizon, and say, look, I'm going to always act professional. I'm going to take care of business. I'm going to treat this very, very seriously. And then these relationships will continue to build, because as you what's interesting is these lenders, they don't stay in one bank all their lives, right? They might move from bank to bank. I have one lender, I think she's on her like fifth bank now, okay, since we've been doing business together. And so that just opens up new doors as you go. And as you bring a new lender in your fold, well, now your stable has 3 lenders instead of 1, right? And over time, you keep on adding those people into your stable, onto your team, right? And then when you have opportunities, you can go out there and talk to all of them about it and figure out which one's the best fit. So this is not like kind of a one and done type relationship. These are relationships that can build and develop over time. And so I think I've dealt with 3 different banking relationships at one organization, where I started with one gentleman. He retired, handed me off. I mean, so and you just continue to grow and get more people onto your team. And then you'll have more access to capital, which leads to more opportunities in the future. So you need to nurture these relationships. Big pro tip there. So lenders are just part of our lifestyle here at the Rocket Guy, right? And in real estate investing. And these lenders could be bank lenders. I know I talked a lot about that, but the same kind of thing applies to private money, friends and family, all that. They all have their assets they're comfortable with. They all have their risks they're trying to mitigate. They all have a return they're trying to get to, but they don't want to lose any money. And the more professional you can be, the more prepared you are for the conversations, the more questions that you've already asked yourself and are answering in advance, the better you're going to be, and the better you are to build these relationships for the long term. So thanks for joining us today at The Rocket Guy. I'm Greg Lafferty, The Rocket Guy, and you've been listening to The Rocket Guy Real Estate Investment Network. Come check us out at therocketguy.com. Subscribe, leave notifications, turn on notifications, do all that kind of stuff you're supposed to do here on these platforms to get us up to the top of your feed. Leave us a comment. I hope you enjoyed the episode today, and hope you build strong lending relationships, and I hope you have a great day.